Okay, so this is Clint Haley, and I will be doing my real estate license. I'm going through the CE Shop currently, so I'm going to be reviewing my first lesson, and I'll be doing all 8 or 9 lessons, however many in this course, and just summarizing the course material and what I went through in the course. So let's start in the lending laws. This is HUD. And HUD's mission is to create strong, sustainable, inclusive communities and quality, affordable homes for all. So that's what HUD does. It's the first thing that we learned and first thing we go over. This includes the Federal Housing Administration, or the FHA. Then the Government National Mortgage Association, which is the Ginnie Mae, and I'll get on that later. You also have community development block grants, fair housing, housing choice vouchers, and Native American housing. So then you have loan disclosures, which is things like loan terms, projected payments, costs at closing, and closing costs. And then there are some legislation such as administrative procedures. This regulates agencies, truth in lending, or TILA, that is that people who are lending things have to have full disclosure of all terms and conditions. Then the Real Estate Settlement Procedures Act, or RESPA, is eliminated kickbacks. Then Federal Equal Credit Opportunity Act, or ECOA, this prohibited discriminatory practices by lenders. Then you had the Home Mortgage Disclosure Act, HMDA. This requires documentation to show that lenders are serving the housing needs for their community. The Community Reinvestment Act is just reinvesting into your community, really. Housing and Economic Recovery, or HERA, that is designed to address the subprime mortgage crisis, which was the downturn in 2008. And then the American Recovery and Reinvestment Act, or ARA, which was also to stimulate the economy in the 2008 downturn. Then Dodd-Frank Wall Street Reform Consumer Protection Act of 2010. It just created stricter regulation of financial industries. And so that is what the lending laws were. Then the financial sources. These were so you can get financing from commercial banks, credit unions. You can get, it's crazy, life insurance companies do offer blocks of single family mortgages from the secondary market, which is very interesting. Then you have mortgage brokers and mortgage bankers. So a mortgage broker is going to find somebody who's selling a mortgage and somebody who needs a mortgage and bring them together, while a mortgage banker is going to offer a mortgage and originate their own loans, while mortgage brokers find loans and put people together. So that's where mortgage brokers and bankers differ. Then you have pension funds and trusts. These are things like REITs, or real estate investment trusts. And there are 3 main real estate investment trusts. You have the real estate investment trusts in equity, which is physical homes such as apartments or buying single family homes. And usually you're going to see them that these are rented out. And so that's where those come in. The second one for REITs, or real estate investment trusts, is mortgage. And that means people are going to buy mortgage on the secondary market, and that they're going to buy it for a $250,000 mortgage. They're going to buy for $200,000. So they're going to invest their money into that, and as people pay that back, they're going to get their money and more, and that's how that's an investment. There are also hybrid REITs, and those are a combination of both, obviously, because of hybrids. Then you have real estate bonds, and these are just used to secure real estate projects. Companies are going to administer bonds, or just real estate bonds. They work like a normal bond. And then you have foreign lenders and investors. China has become a really, really big investor in the US, so you're going to get a lot of Chinese investors coming over. Also you have mutual saving banks and savings associations. They're mostly over in the eastern side of the U.S., and they like to stay in the eastern side of the U.S. They don't like to expand very far, so there's not going to be very many of those over here on the west side. Then you have private financing. These are people who individually have their loans, or sellers, though that's also private financing. So if you're selling your home, it's a private financing. So those are the real estate financing sources. Then you have this secondary mortgage market. The secondary mortgage market is where loan originators sell their loans to a secondary market player. This is usually in exchange for money, and it's used to originate additional loans. Secondary market players package these loans and sell them as MBSs, or also known as CMOs or REMICs. So the GSEs, the first GSE, these are government sponsored enterprises, and that the first one is the Fannie Mae. So Fannie Mae buys conforming loans, so they have to conform, and they're usually from commercial banks, and they can be packaged in MBSs. Then you have Freddie Mac. These also buy conforming loans, but these are mostly from thrifts, so they're not commercial banks. So other than commercial banks, you're going to get Freddie Mac. Then you have the FHLB. This advances money to member banks in exchange for collateral, and the collateral is usually going to be mortgages. And then you have non-GSEs. These are Ginnie Mae's, which guarantees MBSs that only contain loans insured by a U.S. government agency and not issued by private institutors. And that's a Ginnie Mae. It cannot be issued by a private institutor and must be issued by the government itself, like such as an FHA loan or a veterans loan. Then you have Farmer Mac, and this one's super explanatory. It's agricultural loans or rural loans, and that's what the Farmer Mac is. And then investors are also non-GSEs, and they buy shares of mortgage-backed securities. That's an MBS, a mortgage-backed security. So then you have conforming loans. Those are loans that conform to Fannie Mae or Freddie Mac standards. And then non-conforming loans are those that don't conform. Qualified mortgages are loans categorized by the CFPB that do not include risky features such as balloon payments or term greater than 50 years. So those are the qualified mortgages that do not include those. So that is the secondary mortgage market. Then you have financing documents. So these are things such as mortgages and deeds of trust. So those are your two main sources of finance. And a mortgage is just a lien theory. So the borrower holds the legal and the equitable title. So the borrower has both titles, but a lien is placed against the property. So liens are things that they can legally repossess the property if they do not pay their property mortgage or something like that. That's the lien theory. Then you have the title theory, and that is the lender or a trustee holds the legal title, and the borrower holds the equitable title. So the borrower can still sell under a title theory, but they don't own the entire property until the mortgage is paid off. Then the lender or trustee, whoever is holding the legal title, will then give them the legal title for once the mortgage is paid off. So encumbrances, those are a defect on the title, such as a monetary or physical defect, such as a monetary defect is an unpaid tax bill, and a physical defect is actually the neighbor's fence crosses the property line. So it is an encumbrance on the property itself. It's a physical defect and a physical encumbrance on the property. This can make the property unmarketable if you have too many liens or too many physical encumbrances that are on your property. You won't be able to market it. So there are lien types. There are voluntary and involuntary, and then general and specific. So you can have a voluntary specific lien or a involuntary specific lien. or vice versa, involuntary general or a voluntary general. And it depends on whether or not the lien is attached to the specific property or the entire property somebody owns. So a voluntary lien is created by the property owner in like a mortgage. In the lien theory state, it's a voluntary lien that is specifically placed on the property. So it's a voluntary specific lien. And then you have involuntary liens, that these are created by unpaid taxes or debt related to the property. The owner doesn't get to choose to have this lien. It is just placed on the property because something the owner did. A general lien is an unpaid income or estate tax. General liens are usually taxes that apply to the person as a general. Those are going to be general liens, and it is attached to somebody's total property. So all the property they own, cars, things like that. Specific lien is a mortgage loan. It's specifically placed on the property, or a property tax that they didn't pay on their property. That's a specific loan. So lien, and it's just attached to the property itself. So it doesn't expand to anything else that the person owns, just the property. A mortgage does have two parties involved, and that is the lender and the borrower. A security instrument is the house itself. The house is used as collateral, and the mortgager holds the title. So the person who is selling holds the title. A judicial foreclosure is usually required, and that means a court action, that you go to court to foreclose on the house. And mortgage creates a voluntary specific lien against the property. A deed of trust can involve two properties, but it cannot but it can involve three. And this is the lender, the borrower, and the trustee. And the lender can be the trustee, but you can just have a trustee to hold on to the title, so it can have three parties involved. It is a security instrument, the deed of trust is, and it is it has non-judicial foreclosure. So you can just foreclose on the property because you still hold the legal title. You legally can foreclose on it without actually having to go through a court system. So it has a non-judicial foreclosure. And then a promissory note is used for both mortgages and a deed of trust. And it is just a written note that is essentially a promise to repay the loan on the property. Then you have loan programs. So these are things like the FHA. So the FHA is a loan program, and the FHA's goals are to improve housing, develop lending standards, and stabilize and improve the mortgage market. FHA contributes to mortgage finance. They create long-term amortized loans. They develop construction standards. They implemented borrow qualifying standards and require licensing for appraisers of FHA loans, and they create opportunities in the global market for mortgage-backed securities. That's what FHA does. So FHA has a couple of titles. So Title 1 is property improvements. This is loan insurance for moderate rehabilitation of properties. So you can get an FHA loan to improve your property. That's what Title 1 property improvements is about. Title 1 Title 1 purchase of manufactured housing. This is a loan insurance for purchasing a manufactured home to develop a lot on, such as a property. You develop the base for a manufactured home, and then you just put a manufactured home on it. Title 1 purchase of manufacturing home in the FHA. That's where you'll find that. And then you have the Title II programs, and the Title II has sections. So you have Section 203B. This is the purchase of 1 to 4 family homes. So they're going to be a 1 to a 4plex. That's usually what it is. That's Section 203B in Title II. Then you have Section 203H. This talks about how victims of disasters may receive 100% financing to reconstruct or replace a damaged home if they file within a year. So they have to file within a year in Section 203H. Section 203N is the purchase of a unit in a cooperative housing project. So that's going to be something bigger than 4 families, like a 10-plex or 15-plex or a massive apartment building. Section 221D, 3 and 4, this is the construction of multiple family rentals or cooperative projects, such as apartments. Section 223E is the purchase of or rehabilitation of a home in an older, declining urban area. Section 234C is the purchase of a single condo unit. So condo units are in buildings, and you're just purchasing a single unit, not the entire building. Section 25(1) is loan insurance for adjustable rates or adjustable rate mortgages or ARMs, and this is going to fluctuate with the Federal Reserve and how their prices are currently changing. Then Section 255, that's loan insurance for reverse mortgages and for borrowers 62 and older. There are some special programs such as energy efficient, streamline, home equity conversion, good neighbor next door, home ownership voucher assistance, and programs for Native Americans. Those are all other special programs. The FHA does have some requirements. The first requirement is a minimum down payment of 3.5%. So that's the smallest you can get to get of a down payment for an FHA loan. And then you also need to have a housing ratio of less than 31% and a total debt obligation of less than 430. Your credit score can be as small as 500, but 620 is preferred to get it. So if you have a credit score of 500, you're not likely to get it, but anything above 620, you're most likely going to get an FHA loan. Then we move on to VA loans. And VA loans are Veteran Affairs loans, and so no down payment is required for this, but you do have to be in the military, and you have to have a certificate of eligibility or COE that states that you have been in the military and you are a veteran. So your veteran's eligibility is based on length of service, duty status, and character of service. So if you're dishonorably discharged, you are not going to be able to receive a Veterans Affairs loan. Also, with the Veteran Affairs, your debt to income has to be less than or equal to 41%, and there is no down payment required. It's low closing costs, so veterans loans, VA loans are very good for veterans, and they're very very good. Then we move on to loan types and terms. These are conventional loans and government loans. So a conventional loan is conforming to Fannie Mae and Freddie Mac guidelines. But it's non-conforming. So it doesn't actually go into the USDA or VA loans, but it is. So that's a conventional loan. And then government loans are provided by the USDA or the VA or FHA. And usually a loan is a fixed rate 30-year term loan. That means the rate is fixed as soon as you get the loan, like 7% or 6% or something. And then you have growing equity mortgage. This is a principal payment start out smaller and increase in order to gain more equity quickly. And then you have that's called a GEM. And then you have a renegotiable rate mortgage, and the interest rate is periodically renegotiated by the borrower and the borrowee. You also have creative buyer financing. This is where the seller can finance or wrap around loans and construction loans. Then you have home equity loan. It's a lump sum loan based on the accrued equity of the house. And you also have a home equity line of credit, or a HELOC. That's what I call them. They're HELOC. It is an open-ended loan based on equity. Then you have the reverse annuity mortgage, or RAM. The borrower receives monthly payments or a lump sum payment in exchange for ownership of the property. You also have PMIs, or private mortgage insurance. This is required on some loans when the loan to value ratio, or LTV, is in excess of 80%. So if you don't have 20% down or more than 20% down, you need to buy PMI, or private mortgage insurance. It protects the lender in case the borrower defaults on the loan, so the lender will get at least some of the money and the home back. Then you have the Home Protection Act of 1998, and this requires PMI to be canceled when the loan-to-value ratio reaches 78%. So refinancing, this is when the interest rate cost savings may not benefit some borrowers, so they're going to try and refinance their loan. This is possible in most loans, but it will happen frequently in the renegotiable rate mortgage loan. Then you have subprime lending. These are borrowers are rated A, B, C, or D based on their credit worthiness, and borrowers with a B, C, or D credit ratings are subprime. So anything that is lower than a B is subprime. It's similar to bonds in their ratings. And then you have predatory lending and federal legislation. Predatory lending is when the lending is for longer terms, and the percentage rate, the interest is going to be super high, like 15-20% on a single loan, or it's going to be crazy hard to pay back with balloon payments, and they're not going to be upfront about all of the costs and stuff. So that's predatory lending. Then we have estimating the value of certain things, such as the purpose of an appraisal. So an appraisal is an evaluation of the property, and it shows how much a property is worth. That's the appraisal. An appraisal determines property value, and that it appraises things like water, the flooring, how good the house is, the area of the house, and so that's the appraisal. To do an appraisal, you have to be verified. Then you have price, value, and cost. The price is the amount the borrower paid. The value is a property's worth, and it may not be equal to the price. So sometimes you could get a great deal, and the value could be higher than the price that's actually paid, or the value could be lower than the price that was actually paid. So the cost is the amount to recreate that property if it disappeared off the face of the earth. So if the property just vanished, to recreate that property exactly how it is, that's the cost of a property. So to remember the four factors, it's dust, to remember how much a price can fluctuate, or the value or the cost. It's dust. It's demand, utility, scarcity, and transferability. So then you have principles of value. That's conformity, how well it conforms to its surrounding areas. Competition, what other houses are available. Contribution, which is how does the house or the property contribute as a whole. Then you have plottage, how large is it, how big is the house, how big is the property itself. And then you can actually have regression and progression based on the economy. Like the 2008 downturn was a major regression, and right now we're in a progression as housing costs increased greatly. There are also things that you can use to determine how much you can buy a home, such as income multiplier or gross rent multiplier. These are going to determine how much asset it is actually worth. And then you have market conditions, and then you have CMAs and BPOs versus appraisals. And a CMA is not an appraisal, but it's usually prepared at no cost. And BPOs are prepared for a minimum fee, and they generally cost $400, but they're not appraisals. An appraisal is an estimation of a value that's for a specific purpose, party, and property of a specific date. So that's an appraisal. A BPO is a broker's price opinion. So a broker's going to come and look at the property and give their professional opinion on the property and how much they believe it's worth, and then a CMA is a comparative market analysis. And this is just going to be done by the real estate agent. They're going to find a house and compare the house square footage. If the house has similar acreage, things like that, they're going to compare the house and adjust based on the other houses in the area. After the value, we have some of the math. Most of the math is very self-explanatory. It's just areas of like rectangles, squares, triangles, price per square foot. But 1 acre is 43,560 square feet. That is 1 acre. And one hectare is 10,000 square meters, or 2.47 acres. And then a front foot, or a frontage, is the length of the property running along the street, highway, or waterway. So that's how much of it is actually contacting a major street or intersection or waterway. Then you have loan origination fee, and this is how to calculate loan to value ratio. And to calculate that, it's the loan amount divided by the home value times 100. That's the loan equity fee, or loan to value ratio. Loan to value ratio. Loan to value ratio. The equity fee is the appraised value minus the value owed. That's the equity. That's how much equity you have in it. And then points. So 1 point is 1% of the loan, and discount points are prepaid interest borrowers pay at the beginning to reduce their monthly payments. So they can pay 1% of the loan to reduce the monthly payments by so much. Amortization is paying off the loan. And then down payments, a down payment is usually between 3 and 5%. And then you have debt to income ratio, so it's just your total monthly debt obligations, so how much housing tax they have to pay, how much how much their mortgage property is, how much they pay a month for that, divided by their total monthly gross income times 100. That's their total debt. And their housing debt ratio is the principal, the interest, the taxes, and the insurance and the association fees all added together, divided by the monthly gross income times 100. That's their housing debt ratio. Then you have interest, which is pretty easy to calculate. It's the loan balance times the interest rate is the annual interest amount. And then the annual interest rate divided by the loan balance is the interest rate. The annual interest divided by the interest rate is the loan balance. And to calculate property tax, there you have the appraised value times the assessment value is the assessment ratio. The appraised value times the assessment ratio is the assessed value, and the assessed value times the tax rate is the annual property tax. And so to calculate my commission as a real estate agent, it is going to be however high the percentage of the commission rate is times the amount sold. And that is the formulas that I will be using. And then there is real estate finance. This is things like total debt to, just like what I talked about, debt to total debt and debt to income, loan to value ratio. And the loan to value ratio is the amount financed divided by the property value. Then you have monthly principal. This is the loan amount divided by 1,000 times the factor from the amortization chart. And then you also have net to seller, which is 100% minus the commission percent times the sales price, and that's going to be your net to seller. And appreciation is the original value times appreciation percent, and that's going to get your appreciation. So those are finance, and then you have the defaults. So defaults are when you miss mortgage payments or you miss property taxes, you are going to get a default on your property. And so with too many defaults, you could get a foreclosure, and this occurs when the borrower, usually the property owner, defaults, and then the owner of the property actually takes back the property and then sells it. And so you also have deficiency judgments. This is things, it's a very rarely used, but it's a lender's pursuit of amount still owing after foreclosures. So foreclosures usually do not equal the amount of the original agreement of the sale. And so when that happens, a deficiency judgment is making it so that the person who did default on the mortgage still has to pay the rest of the mortgage. So if the mortgage was worth $250,000 and the foreclosure only got $225,000, then the borrower still owes $25,000. There are some alternatives to a foreclosure. There are loan modifications. This is where you go in and modify the loan. There's a short sale. This is where the current owner, the person who is borrowing, sells the house as quickly as possible for whatever price comes in. And that is usually going to be short of the mortgage rate, but you're usually going to get a better deal on that than you will a foreclosure. Then you have tax implications of foreclosure. This is if the lender waives a deficiency judgment, then this may be conducted as a taxable income from the borrower. And that was the final thing in